Folks, I have a true treat for you. I have somebody that is deep and experienced in the large multifamily space. As you know, folks, the largest thing I've bought to date was 20 units, but we're talking hundreds of units, 10s, 20, 30, $40 million. We're going to talk with Anton from Peak Financing. How you doing, buddy?
Hi, Michael. Doing great. How about yourself?
That's great. Well, do us a favor, introduce yourself to the audience a little. Tell us a little bit about Peak Financing because we got a lot to talk about. Because I think there's been some nuttiness done the last 2 years. But let's start with who you are and what you do.
Sure. I'm based in Dallas. That strange accent is not a Texan accent. I was born in Switzerland. And for as many Swiss, I ended up on the financing side. So I studied finance, then joined UBS, which is one of the largest investment banks in the world. Worked in New York, Tokyo, Hong Kong.
Oh,
That was
wow.
all great. Unfortunately, the family never saw me during that time. And so I
Yeah.
left banking and we started investing together with family offices in commercial real estate, first in Europe, and then we had a number of opportunities in the US, including Texas, also oil and gas, and that's why I ended up in Dallas. Uh, our firm, Peak Financing, we are a commercial real estate debt brokerage firm. So we find the right lenders for the right project and the right sponsors.
Awesome. Awesome. Well, we're going to talk about lending and opportunities going forward, but I'd be remiss if we didn't talk about the nuttiness of the last 2 years because I believe, and it'll be great to get your opinion because you're playing in a space that I'm a fan of. I've never played in that game, but I see a lot of similarities between the '05, '07 residential lending market and let's call it the 2021, 22 large multifamily. And I see that. I'd be curious what you see, and if you see similarities, what are some of those?
Yes, definitely. Right. So when we look back to the single family space, obviously everyone rushed in, regardless of experience. Lenders came in with all the teaser loans, liar loans. So you had a very low starting rate, and that rate then was supposed to be resetting down the road, but no one really cared about it. And so that's why that bubble was created. On the multifamily side, now in 2021 in particular, and into early 2022, the Fed, in a way, created these teaser rates by lowering the Fed rate to zero, keeping it there for an extended period. Everyone was talking about inflation risk, but as we know, people just talked about it at the Fed level. Oh, it's only transitory until they realized it wasn't. But
Right.
during that time, interest rates were so low and liquidity that was also with the stimulus on top of it that was pumped into the marketplace. Everyone wanted to invest, and as a result, a lot of new players also came into the multifamily market, the so-called syndicators that had very little experience, went with primarily bridge loans. Just to put that into perspective, typically pre-2020, for all the multifamily loans that we have been originating during that time, I would say bridge loans made up maybe 20% of all that. So it was primarily really for value add deals, true value add deals. In 2021, we originated more than $1 billion during that time in 1 year. 90% were all bridge loans, right? So
Wait. So in a normal market, let's call it 2018, 19, there would be some bridge debt, but it would really be for operators who had a plan, they had experience, and they had a process to do true value add. What you just said, I have not heard before. And I want to make sure I heard it right. 2021 origination, so net new loans, 90% were bridge debt.
Yes, for the syndicators, right?
Right,
So
right,
now,
right.
obviously,
Oh,
institutional players are
yeah,
different, right? So
yeah, no,
they
no,
always have gone with lower leverage, and even during that time, they just lowered the leverage very often to 45-50%
right,
LTV, so that they
sure.
still could do the agency loans. I'm specifically talk about the syndicators where everyone,
Hmm.
because values were pushed up so much, if you wanted to buy a stabilized property, which we define as 90% plus physical occupancy, uh, you essentially had a choice between going with an agency loan at 50, maybe 55% LTV,
Mm.
or a bridge loan that allowed you to get up to 80% LTC, loan to cost, right? So
Yeah, this is where it got really bad, 2021. And again, it's we saw all of these people, these programs being created, teaching people how to syndicate. Money was sloshing around the system. People started to overpay. I mean, I know of some very conservative investors like Ken McElroy, who didn't do a deal for like 18 months or 24 months because nothing penciled. Everybody was overpaying by 20, 30, 40 million. So not only the bridge debt, I think it even got worse because then it went from bridge financing to bridge IO, right? The only way we can make these things pencil is with IO debt. And it's just like, man, this is so similar to the stupidity in single family homes that started in '05 and ultimately blew up and caused the GFC. The similarities are shocking.
yes, it certainly is. Bridge loans generally are IO
Okay.
only loans to begin with.
Okay.
Uh, but I think where things also really were driven to these extreme loan proceeds were also the exit assumptions, right? So it's really not just the syndicators, it's also the lenders that were extremely aggressive. Right, so a lot of these loans that were done, they had refinancing rates around 4% as assumptions, right?
Oh,
And
wow.
you needed those in order to get to the loan proceeds, right? So most bridge loans are underwritten to, roughly speaking, to a 3-year exit. And
Okay.
obviously you need to have an NOI that is going up enough to justify the original bridge loan, and that you can refinance into an agency loan, let's say, or another permanent loan. In order
Sure.
to achieve that high leverage, very often you had to push the rents to as much as you could in your underwriting, keep expenses as low as you can, and then also apply an assumption when it comes to the refinancing rate that was low enough so that you could refinance out of that bridge loan in year
Yeah.
3. Right.
Yeah. And again, this is why a lot of these are blowing up because again, rent assumptions. I mean, I saw rent. I'm an accredited investor, been that for a while. The stuff that I was getting pitched got increasingly worse. Like the last couple that I looked at before this started to blow up, everybody assumed a 5% rent growth every year. I'm like, yeah, you might have got that in 2020 or 2021, but that's, I'm not going to invest in something that assumes 5% from now to forever. Then they have these crazy expense assumptions. I actually run properties and they were thinking they're going to run a big property for less than I could run a house. That ain't happening. Then they were talking about insurance and taxes going up. I'm like, you guys are, wait, I mean, did a third grader make this chart? I mean, what are you doing? And then
Yeah.
the last thing you brought up is the nail in the coffin was the exit refi rate. If your assumption was, and you did this in 2021, 90% of the loans from syndicators were bridge, that means, so 2021, so that'd be 23, 24 exits. The actual, refi rate is what, 7.5 today, 6.5, 7. I mean, what is the refi rate today? It ain't 4.
Yeah, so it depends a little bit on the deal size. If it's a larger loan, let's say 10 million and up or 6 million up, but in most cases 10 million and up, right now you will be somewhere around the 6.5% range for a 10-year fixed rate loan. You cannot go shorter because, as you know, the yield curve is still inverted, so there is no escape from that permanent rate that is has a 6 in front in the best case. If you
Right.
have a smaller deal, we talk about 7 to 8%, right? Small balance
Wow.
Freddie as an example, and small balance Fannie, that's typically below 6 million.
Mhm.
That is just around 7.5, depending on the affordability discount that you can get to 8%, right?
Yeah.
So obviously it's significantly higher. So essentially, if you had a 70% LTC loan that you took out in 2021, you
Yep.
could go up to, and you met all your NOI projections, right? That obviously is also another aspect where we see a lot of pain there because, as you mentioned, a lot of these assumptions were so aggressive and a lot of syndicators cannot meet them. But
Yeah.
even if you met those, you could not be above 70% LTC at the origination in 2021 to get
Right.
out at the 6% loan. Now at 6.5, you had to be below 70% LTC, right?
Right.
Assuming that you achieve your NOI. So anyone else who was above 70% LTC, even if they achieved their on our planning or able to achieve the NOI, they are still not able to get out of it at the 6.5% rate, right? So they need still either get above that NOI that they projected or bring in more equity.
Yeah, there's going to be a lot of cash in refis, a lot of capital being raised, capital calls, and also a lot of people just going, "Oops, I'm out," right? Because a lot of these syndicators probably don't have any of their own money, or at least a very small percent of their own money. They were hoping for the cash on the exit. It's not there. Non-recourse, all of that. So um, this will be cleaned up, though. One of the things that the system really does is it will eventually chew through all of these, and frankly, the owners are going to be replaced with new operators. I'm seeing more and more distressed funds. I think there was another one, the Real Deal just talked about yesterday, $350 billion being set aside to kind of soak up some of these, because a lot of these buildings, the asset is fine. It's the debt stack that is atrocious. Is that kind of how you see it as well?
Yes, so not all of them the asset is that great, right? So one of
True. True.
one of the issues that we have seen, right? And I know you have talked with Anna about interest rate caps, and Jonathan too. The problem is that a lot of these borrowers are cash strapped to the rate
Yes.
and interest rates, right? So what
Mhm.
does that mean? Now they cannot do all the renovations that they originally planned. They cannot maintain the property in a proper fashion. They may have to
Ugh, yuck.
marketing, you name it. So now we see a lot of these properties that are financially struggling,
Yep.
they're also operationally struggling, and some of
Mm.
them are now in a situation where they are not just financially distressed from a financing perspective, but they are actually operationally distressed, right? And those properties, there is no rescue for them at all.
No.
They have to go back to the lender, or the lender is willing to find someone who is
To
coming in
step in. Yeah.
and buy them out, right?
Yeah, so there is a lot of pain coming to LPs, because one thing that is different between the Great Recession in single family and today is, excuse me, the banks were taking, 99% of the hit because there was very little equity in single families. Today, even with these aggressive lending, you still had 20, if not 25 or 30% equity. So equity is going to get whacked first, go to zero before lenders take their haircut. Is that a fair statement?
Yes, that's only the case. I would say for some of the deals that went into foreclosure, uh, the lenders tended to take a cut maybe of from none to maybe 5% to
Right.
10%.
But the
Right.
equity went to zero.
And the equity went to zero. Absolutely. Yeah.
Yeah. So these are all things we've been talking about on this channel. There is opportunity right where there's great pain. There's great opportunity. I think there's some distressed assets. I think we're really in the first inning of this to have the assets, but maybe I'm wrong. You're in this space. If we use a baseball analogy of 9 innings, where are we in this, and how long do you think this stretches out? Do we go into 2025 with some opportunities, or how long do you think this might be to clean up?
Yeah, I would say we certainly are in an early inning. Are we getting into 25 to sort this out? Absolutely, right. So
Mm,
uh, uh, we have maturities that are coming up now next year and in 2025 that
okay.
are pretty significant in that bridge space on top of all the other natural maturities, right? So we
Sure.
have obviously every year we have several hundred billion in multifamily maturities that are appearing. Now, when it comes to the bridge loans, it's a little bit hard to tell what the total number is, right? We know we can track the securitized bridge loans very well because it's you once you subscribe to TREP and other services, you know exactly what is being securitized. What is much harder to track are the loans that have not been securitized, as well as what is in with life insurance companies,
Mm,
as well as with banks, right? So banks are not reporting, oh, these we have X amount of bridge loans, right? So it's
right.
just multifamily. So, but I would say the typical bridge loan structure or quasi bridge loan structure, I estimate that we have around 50 to 60 billion that are going to mature next year.
Yeah.
Uh, and uh, of those, I would say at least half have some form of a distress
Yeah.
attached to them, right? And I know you had a guest on who has also set up a fund looking to rescue some of these.
Yeah.
And I think he mentioned that a fifth of all the ones that they're looking at are actually
Savable. Yeah.
savable, right?
That is scary. That is again. I forget the firm. I'll look it up. Put it in the show notes. But yeah, he's evaluated 600 billion in assets, and yeah, I think he said about 1/5 can and by savable. That just means the LPs don't go to zero. That means they get a little bit. They're going to take haircuts, but it's frightening to think that 4/5 are going to zero. That was scary.
Yeah, so I would put it a step further and say savable in a way that it's worthwhile for someone like that firm, whether it's
Mm-hmm.
pref equity or whatever it is, to actually come in and being willing to inject capital
Right.
into the existing GP structure, right? So in most instances, it's actually better just to buy them out.
Yep.
And in most instances, the LPs will lose the majority of the money, if not all, and the
Yep.
GPs will also lose the majority.
Yeah. Well, let's kind of hopefully finish on a better note. So if the nuttiness of 2021 is going to be biting us until 25 and 26, how is lending today? Is it gotten a lot more conservative, a lot less bridge debt? There are deals still being done. I'm guessing LTVs are much lower, but make me feel better. Make me feel like we only got a small window of pain.
Yes. Lenders are still out there. Obviously, multifamily is a unique space because we have Fannie, Freddie, we have HUD lenders and others, right? So there is more availability of financing in the multifamily space than in any other commercial asset class. So that is the great news. Fannie and Freddie, they are lending as long as the deal underwrites. So it is not a problem to get a Fannie or a Freddie loan as long as the numbers make sense, right? So the challenge is that still today, sellers are not where they need to be in order to
Right.
get for the buyer to get a reasonable leverage. But I think it over the next few months to 12 months, it's going to change, and that's where the opportunities are. So for stabilized properties, financing is available. Yes, the leverage might be at 55, maybe at 60, 65%.
Right.
But if you have a 10-year loan and you cash flow, does that really matter, right?
Yeah.
You just have to take a little bit of a different approach rather than that value creation, value
Right.
add view where you exit in 2 or 3 years with a big upside. You just come in more as a cash flow investor. Now, if it's a true value add property, and obviously some of these loans that are in distress and these properties that are in distress, you may have to come in with another bridge loan. the bridge loans are available. It's not that they are not available. It's just that it's very costly, right? So
Right.
you talk here about SOFR is at around 5.3%. Most spreads over SOFR are around 3% to 4%. So we talk
Okay.
about 8.5 to 9.5 to 10% for bridge loans. So it's
Yeah.
expensive, but as long as it's a true value add, it doesn't matter, right?
Right. Yeah. What I hear you saying is, um, these are my words, not yours. You feel free to disagree. The next couple of years, the good operators are going to win, whether it's just cash flow investors or true value add specialists. We just had a 2-year window where financial engineers, people who played with Excel spreadsheets and just changed variables with no experience, we got to pay that price. So the financial engineers are going to get hurt, but the true operators, the good people that actually operate buildings, they're going to be fine. They're it's just going to go forward as is. That's what I hear you saying. Is that fair?
Yes, absolutely. Right. So obviously a lot of the newbies indicators, they are being flushed out. The more experienced indicators, they will have staying power. They already have a good capital base. They will pick up more deals and they will grow. And more likely than not, there will be some brand new players that have been sitting on the
Yep.
sidelines and strategizing that will pop up. And it wouldn't surprise me if we, in 3, 4, 5 years from now, we hear of some names that have started out doing that time. So, in summary, it's a great time for someone to really get into that business. I'm not saying
Mhm.
that the values are where they need to be right now, but you cannot just start out when the
Yep.
values are at the bottom. You need to
Right.
get ready. So I would suggest anyone who has an interest in investing in multifamily, it's actually an excellent time to start that in earnest.
Yeah. Do the work. Get educated. Because again, there'll be where there's great pain, there's great opportunity. We clearly need to pay the price of some lax lending and unrealistic assumptions and short-term debt and all that thing. Time to get educated, do some work. Anton, if somebody wanted to reach out to you and understand financing options that Peak has, how would they do that?
Yes, so you can find me on social media. I'm on LinkedIn, Facebook, Twitter. You also can reach me at anton@peakfinancing.com. We also have a sister site that is primarily for passive investors, so they can share with each other their experience. It's called alternativeinvestors.net, which is a closed network. It's not like Facebook where everyone can join.
Mm,
It's we verify every single person there, so it's a good way to for people to discuss deals with each other.
very cool. Thank you for being here. Thank you for bringing a whole new set of experience and education. You've helped me understand better, and I'm sure the audience. Thank you for your time.
Yeah, thanks for having me on, Michael.
You got it.